It's Peter Okoye here. This is a bonus video that wants to just educate you and give you more insight, especially on the investment industry. Now we're talking about what is ETF. If you're hearing ETF, maybe if you are familiar with investment industry, or maybe once in a while when you are browsing, you've seen ETF. Now, ETFs, these are traded funds, just like a collection of securities such as stocks. So different type of stocks. There are different stocks. We have the stocks from the financial sector, stock from the agricultural sector, stock from pharmaceutical sector, stocks from different sectors. So an ETF is just that's the full meaning of ETF is exchange traded fund. So it's a collection of these several stocks which is put underlining in an index. An index is a group of stock categorized and viewed as one. So an ETF is a collection of stock. They are used to track an underlying index, which means they can be put together and categorized as a particular stock. So their prices can go up and come down. But in this kind of stock, in this kind of trade, although you can invest in any number of industry or various strategies, they are very similar with mutual funds, but they are not listed on the exchange. That is it. They are similar because it's a well diversified kind of investment. Just like you pull from the financial sector, as I said earlier, you pull from agricultural sector, pull from pharmaceutical sector, pull from construction, pull from this, pull from that, and you merge them together and they become a particular, like as if a particular stock, and you trade them. So in this ETF, it's a collection of several stock, and it's just like a mutual fund. It helps to diversify your investment and reduce the risk that are attached with stock. But the thing is, they are not listed on exchanges. They are not like ordinary shares that are listed on exchanges. So that is it. So the key takeaway from this is a basket of securities, a basket of shares that trade on the exchange like stock. So the price they are bought and they are sold is different from mutual fund that only trade once a day after the market closes. But these ones, they are bought, you can buy it, you can come anytime in the market and buy, and you can come and sell. I think one of my colleagues has dealt with the mutual fund, so there will be no need. If you peradventure you missed that, I think maybe you can watch the video, or you can make reference to some of the teachings and get much more. So the ETFs contain all type of stock, including stocks, commodity or bond. So if you look at, as I said earlier, they contain several stocks from different sectors. And lastly is they offer low expense ratio and fewer brokers commission than buying stock individually. Now, these are the advantages of the ETF. You have lower expenses ratio, few brokers commission than when you are buying the stock individually. Like some stocks, when you are buying, some of the stock brokers charge about 1.5% commission, depending on the stock brokers. But in this, you see, that doesn't mean they don't charge, but it's way much more lesser. And that's that for that. So we'll go to REIT. I don't know if you have heard of REITs. Now, this REITs means Real Estate Investment Trust. It's a pool of fund, or let me say generally owned, managed income producing commercial real estate. Whether it's properties themselves or mortgage on those properties, you can invest in this company through an exchange traded fund or with a mutual fund. So this REIT is just like a trust fund where a company invests in the real estate sector. So people pull up their fund, and you can use these funds to invest in real estate, and they give you a commission. They give you commission from investing in this real estate investment trust. So it's like a pool of funds. Sometimes these trusts lend money to people. They use this money to build, develop properties, sell and bring back. So this fund helps. You can invest in this fund. It's viable, but you need a lot of information. I think I'll stop it. So the key with using REITs, key takeaways from the REITs is using REITs to invest in real estate can diversify your portfolio, but not all REITs are created equal. Now, real estate is a form of diversification of investment. If you know the investment industry very well, real estate is an illiquid industry. It's not like the stock where you can liquidate your capital. I hope I'm not speaking too much financial jargons for you not to understand. To liquidate means to easily turn your ownership or your share or your stock into cash back as fast as possible. That means it means to liquidate. Now, in the real estate industry, if you have a house, it is hard for you to get maybe a buyer today and sell it. Or maybe you want to buy a house, just wake up tomorrow and you see a house. Sometimes it takes time. So that is it for the real estate industry. But for the stock industry, you can wake up tomorrow morning and decide, oh, I'm no longer interested in this stock. Tell your stockbroker or initiate trade by yourself and issue either a stop, a buy, or a stop, or a sell, and immediately it works. So that's let me not divert. So some REITs invest directly into properties, earning renters income. Some of these investments, real estate investment trusts, they invest into direct properties, and they earn rental income and management fees. Others invest in real estate debt, maybe mortgages, mortgage-backed securities. In Nigeria climates, we are not that familiar with mortgages, or it's not that too pronounced, I would say. But if you look at some of these other countries, some developed worlds, some more advanced world, let me not say developed world, I beg your pardon, you see that this mortgage system work very, very well. And lastly, this real estate investment trust, that's REITs, they tend to focus on specific sectors of properties. For instance, they focus on commercial properties. Some are such as retail or shopping centers, hotel and resorts, healthcare and hospitals. So they focus on basically large expanse of real estate. For example, one individual might not be able to gather the money to build a healthcare center, or to build a hospital, or to build a 5-star hotel. But this investment trust can be able to pool funds together from individuals, build these large edifice, hotels, earn the profit from it, then share back to those who have invested in this real estate investment trust. So I believe you've learned so much on this. So there is where we draw the curtain for today. So I will encourage you to subscribe to Smart Investors. Both follow us on our Facebook page to get more information. And if you want to partake in a much more advanced class, then you can do well to subscribe and follow the instructions after the video. Thank you once again for listening, and have a wonderful time.